Welcome to our latest video, 8 ways to save tax in India. Taxes are an essential part of our financial planning, and finding ways to save on them can help you maximize your savings and achieve your financial goals. In this video, we'll explore various tax saving options and strategies that you can use to optimize your tax savings and secure your financial future. So, let's get started. Section 80C Deductions. Invest in tax-saving instruments like ELSS, PPF, and NSC. One of the most popular ways to save tax in India is by utilizing deductions under Section 80C of the Income Tax Act. This section allows you to claim deductions of up to 1.5 lakh rupees on certain investments, which can significantly reduce your taxable income and overall tax liability. Equity-Linked Savings Scheme, ELSS. ELSS is a type of diversified equity mutual fund that offers tax benefits. Investing in ELSS funds not only qualifies for tax deductions but also offers potentially higher returns compared to other fixed income investments. Keep in mind that ELSS funds come with a 3-year lock-in period and carry market risks. Public Provident Fund, PPF. PPF is a popular long-term investment option that provides tax-free returns and a safe investment avenue. With a 15-year lock-in period, PPF is suitable for long-term financial goals like retirement or children's education. The interest earned and the maturity amount of PPF are exempt from tax. National Savings Certificate, NSC. NSC is a government-backed small savings scheme with a 5-year lock-in period. It offers guaranteed returns and is a safe investment option. The interest earned on NSC is taxable, but the principal amount invested qualifies for tax deductions under Section 80C. By investing in these tax-saving instruments, you can claim deductions under Section 80C and effectively reduce your taxable income. Make sure to assess your risk appetite, financial goals, and investment horizon before choosing the right tax-saving instrument for your needs. Home loan benefits. Save tax by claiming deductions on home loan interest and principal repayment. Another excellent way to save tax in India is by taking advantage of home loan benefits. If you've taken a home loan, you can claim deductions on both the interest and principal repayment components, which can significantly reduce your taxable income. Principal repayment deduction. The amount you pay towards the principal repayment of your home loan is eligible for tax deductions under Section 80C, with a maximum limit of 1.5 lakh rupees. This deduction is available for both self-occupied and rented properties. Interest payment deduction. The interest paid on your home loan can be claimed as a deduction under Section 24(b) of the Income Tax Act. For self-occupied properties, the deduction limit is 2 lakh rupees per financial year. In the case of rented properties, there is no upper limit on the deduction for interest payment. Additionally, first-time home buyers can claim an extra deduction of up to 50,000 rupees per financial year under Section 80E, provided they meet certain eligibility criteria. By claiming home loan benefits, you can enjoy substantial tax savings while also investing in an asset that appreciates over time. Make sure to keep accurate records of your home loan repayments and interest payments to claim these deductions and optimize your tax savings. Health insurance. Utilize tax deductions on health insurance premiums under Section 80D. Health insurance is not only essential for securing your family's well-being, but it can also help you save tax. Under Section 80D of the Income Tax Act, you can claim deductions for the premiums paid towards your health insurance policy, which can further reduce your taxable income. For individuals below the age of 60 years, you can claim a deduction of up to 25,000 rupees per financial year for the health insurance premium paid for yourself, your spouse, and dependent children. If you are a senior citizen, the maximum deduction limit increases to 50,000 rupees per financial year. Additionally, if you pay health insurance premiums for your parents, you can claim an extra deduction of up to 25,000 rupees per financial year if they are below 60 years of age, and up to 50,000 rupees if they are senior citizens. It's important to note that the health insurance premium must be paid through any mode other than cash to be eligible for tax deductions under Section 80D. By utilizing tax deductions on health insurance premiums, you can safeguard your family's health and save tax at the same time. Make sure to choose a comprehensive health insurance plan that meets your family's requirements and keeps you financially protected against unforeseen medical expenses. National Pension Scheme (NPS). Invest in NPS for additional tax benefits under Section 80CCD 1B. The National Pension Scheme, or NPS, is a government-backed, voluntary pension scheme that aims to provide financial security during retirement. Investing in NPS not only helps you save for your retirement but also offers additional tax benefits. Under Section 80CCD 1, the contributions you make towards NPS can be claimed as a deduction within the overall limit of 1.5 lakh rupees under Section 80C. Additionally, you can claim an exclusive deduction of up to 50,000 rupees per financial year for NPS contributions under Section 80CCD 1B. This deduction is over and above the 1.5 lakh rupees limit under Section 80C, allowing you to save more tax. If you are a salaried employee, your employer's contribution towards your NPS account is also eligible for tax deductions under Section 80CCD 2. This deduction is subject to a maximum of 10% of your basic salary plus dearness allowance. By investing in NPS, you can secure your retirement and enjoy significant tax savings. It's important to note that NPS has a lock-in period till the age of 60, and early withdrawals are subject to certain conditions. Make sure to consider your financial goals and retirement needs before investing in NPS. House Rent Allowance, HRA. Claim HRA exemptions to reduce your taxable income. House Rent Allowance, or HRA, is a component of your salary that's provided to cover the cost of rented accommodation. If you live in a rented house, you can claim HRA exemptions to reduce your taxable income, thereby saving on taxes. To claim HRA exemptions, you need to submit your rent receipts and your landlord's PAN if the annual rent exceeds 1 lakh rupees. The tax-exempt portion of your HRA is calculated as the minimum of the following three options. A. Actual HRA received from your employer. B. 50% of your basic salary plus dearness allowance, 40% for non-metro cities. C. Rent paid minus 10% of basic salary plus dearness allowance. By claiming HRA exemptions, you can effectively reduce your taxable income and save on taxes. It's essential to maintain accurate records of your rent payments and submit the required documents to your employer to claim HRA exemptions. If you're self-employed or don't receive HRA from your employer, you can still claim deductions for rent expenses under Section 80GG of the Income Tax Act, subject to certain conditions. Education loan. Avail tax deductions on interest paid on education loans under Section 80E. Education loans can be a significant financial burden, but they can also help you save tax. Under Section 80E of the Income Tax Act, you can claim tax deductions on the interest paid on education loans taken for higher education for yourself, your spouse, or your children. The deduction under Section 80E is available only for the interest component of the education loan, not the principal repayment. There is no upper limit on the amount of interest that can be claimed as a deduction under Section 80E. This means you can claim the entire interest amount paid during the financial year as a deduction. The tax deduction under Section 80E is available for a maximum of 8 years, starting from the year in which you start repaying the interest on the education loan, or until the interest is fully repaid, whichever is earlier. By claiming tax deductions on education loan interest payments, you can reduce your taxable income and save on taxes. Make sure to keep accurate records of your education loan interest payments and submit the required documents, such as the interest certificate issued by the lending institution, while filing your income tax return. Long-term capital gains. Understand the tax implications of long-term capital gains and save tax through strategic investments. Long-term capital gains, or LTCG, arise when you sell assets like stocks, mutual funds, or property after holding them for a certain period. Understanding the tax implications of LTCG and making strategic investments can help you save tax. For equity-oriented investments like stocks and equity mutual funds, LTCG tax is applicable if you hold the investments for more than 1 year. LTCG exceeding 1 lakh rupees is taxed at 10% without indexation benefits. For debt-oriented investments like debt mutual funds and fixed deposits, LTCG tax is applicable if you hold the investments for more than 3 years. LTCG is taxed at 20% with indexation benefits, which can help reduce your tax liability by factoring in inflation. For real estate, LTCG tax is applicable if you hold the property for more than 2 years. LTCG is taxed at 20% with indexation benefits. You can also save tax on LTCG from the sale of property by investing the gains in specified bonds under Section 54EC or by purchasing another residential property under Section 54 of the Income Tax Act, subject to certain conditions. By understanding the tax implications of long-term capital gains and making strategic investment decisions, you can optimize your tax savings. It's essential to consult with a financial advisor or tax expert to plan your investments and ensure you're well informed about the latest tax regulations. Tax planning for senior citizens. Explore tax saving options tailored for senior citizens. Senior citizens, aged 60 years and above, have specific tax saving options and benefits under the Income Tax Act. By exploring these options, senior citizens can optimize their tax savings and secure their financial future. Higher basic exemption limit. Senior citizens enjoy a higher basic exemption limit of 3 lakh rupees, and for super senior citizens aged 80 years and above, the limit is 5 lakh rupees. This means that they don't have to pay tax if their annual income falls below these limits. Higher deduction for health insurance premiums. Senior citizens can claim a higher deduction of up to 50,000 rupees per financial year for health insurance premiums under Section 80D. Deduction for medical expenses. Senior citizens can claim a tax deduction of up to 50,000 rupees for medical expenses incurred for themselves and their dependents under Section 80DDB. Investment options. Senior citizens can invest in tax-saving options like the Senior Citizens Savings Scheme, SCSS, and the Pradhan Mantri Vaya Vandana Yojana, PMVVY, to enjoy higher interest rates and tax benefits. By exploring tax-saving options tailored for senior citizens, they can optimize their tax savings and secure their financial future. It's essential to consult with a financial advisor or tax expert to plan investments and tax saving strategies according to individual financial goals and requirements. Thank you for watching our video on 8 ways to save tax in India. We hope that these tax saving strategies and options have given you valuable insights into optimizing your tax savings and achieving your financial goals. Remember, it's essential to plan your taxes and investments carefully, considering your individual financial needs and goals. Consult with a financial advisor or tax expert to ensure you make the most of the tax saving opportunities available to you. If you found this video helpful, please give it a thumbs up, share it with your friends and family, and subscribe to our channel for more informative content on personal finance and tax planning. If you have any questions or suggestions, feel free to leave a comment below. Until next time, happy tax planning, and take care.